Everyone wants to know where is next to buy, but here's a better question. Where are the risk-adjusted returns still worth chasing? I'm Stephen Glynn, a multi-million-dollar property investor and founder of The Edge Property Buyers. We specialize in sourcing investment-grade residential real estate for long-term wealth builders. And right now, there are two markets I'm actively buying in. Let me show you why and how you can use the same logic to sharpen your own investment decisions. When you're investing for long-term growth, where you choose to buy matters more than almost anything. But that doesn't necessarily mean your focus should be on what's growing today or where the headlines are focused. You need to understand how different markets behave over time, what their underlying drivers are, and how they hold up when conditions change. And when you start thinking that way, in other words, not just about growth, but about resilience, it naturally leads to a conversation about risk. But here's the thing, in property, risk doesn't necessarily come from poor locations or cheap stock. It's far more dynamic than that, and actually often comes from misreading timing, misjudging value, or assuming that quality alone is enough. For example, a high quality asset in the wrong context can still be a risky move, which is why we don't just assess a property's potential, we assess how and when the potential is most likely to be realized. So if you look at it from that lens, risk in property investment isn't a single concept. It plays out differently depending on the time frame you're looking at. So first, there's long-term risk, which is driven by fundamentals like population growth, infrastructure, employment hubs, education, transport, and lifestyle appeal. These are the things that make a location desirable not just today, but for the next 10, 20, and even 30 years. Then there's short to medium term risk, which is more about timing, pricing, and the holding strategy. Here, it's not just about quality of suburb, but instead it's about the value you're getting at the time you enter the market. That distinction is critical because you can buy an objectively high quality asset, but if it is overpriced, if the yield doesn't support the cash flow, if the suburbs already run too far ahead of the fundamentals, that becomes a different kind of risk. Jeff Bezos once said, it's easier to build a strategy around what is going to be the same over the next 10 years, rather than trying to predict what will change. That's a helpful frame for property investment as well. So instead of asking, where's the next growth suburb? A more useful question is, what will still be true about Australian housing demand in a decade from now? Will people still want to live close to top performing schools? Will the highest paying jobs still be in our capital cities? Where will most of the new immigrants settle? Where will major sporting, cultural, and business events continue to be held? Where is the most sought after area and scarce land going to be decades from now? As a higher and higher percentage of the population is born overseas or have most of their family living overseas, will they want to live close to major international airports? Where will transport, universities, and political influence remain concentrated? When you apply that lens, the same three cities constantly rise to the top, and that's Sydney, Melbourne, and Brisbane. So from a long-term perspective, these are the boats, as Warren Buffett put it, are moving in the right direction. It's not about how hard you row, it's about what boat you are in. The problem with Sydney, even though it still ticks many long-term boxes, is that it's not enough on its own. We also need to assess short to medium-term entry risk. This is what I mean by risk being dynamic. Because even in blue chip suburbs, a high quality asset can be priced to the point where it becomes risky. Not because it won't grow over time, but because the upside is already priced in. So let's take Bondi as a good example of this. It's a suburb that everyone knows and it's a premium location. Strong long-term demand. But if you're buying in at a price point where the suburb is fully valued or even overpriced and the yield is low, then you're taking on more short-term downside risk while limiting your near-term upside. That doesn't mean that Bondi isn't a great location. It just means that even the best suburbs may not be the best for investment purposes today. And this is an important distinction. We're not just looking at the quality, we're looking at the quality relative to price and risk, which is why Brisbane and Melbourne are currently the only two markets I'm buying in for myself and for my clients. And the reasoning is simple. They offer the best mix of long-term fundamentals and short-term value. In Brisbane, we're still seeing strong affordability relative to income, strong migration, infrastructure investment, and a growing identity as a capital city. There are blue chip inner and middle ring suburbs that haven't yet fully priced in their growth potential, and they still offer sustainable yields. Here are 2 examples of recent purchases that we have made that fit our long-term and short-term risk profiles. These 2 suburbs meet our long-term risk profile requirements as they are in tightly held, sought-after, essentially fully developed areas. They check all our boxes from a demographic perspective, and all the data is trending in the right direction. So where are these locations? First up is this property that we purchased for a Sydney-based couple in Lower Moreton Bay in a suburb called Bray Park for just over $800,000 and yielded 4.3%. The suburb data is strong from a short-term perspective at 26 days, and the vacancy rate is essentially non-existent at 0.3%. Ticks all the boxes to fit into our short-term risk profile checklist. The second property is also just north of the river and sits in Brisbane City Council in the suburb of Boondale. We recently purchased this property for $1.1 million and rented it for $850 per week, which was a 4% yield. A strong yield you don't see in many other capitals outside of Brisbane in a $1 million plus suburb like this. Days on market are low at 38 days, and again, vacancy rate is only 0.5%. The turnover in this suburb is low, and there isn't much social housing, so it fits well into our short-term risk profile. In Melbourne, parts of the market are still underpriced off the back of the COVID-driven corrections. But the fundamentals, job hubs, universities, infrastructure, and lifestyle drivers are still intact. And for the price points that many of our clients are working with, we're able to secure high-quality properties in established areas that we believe will be significantly more expensive in the years ahead. When we zoom out to consider population, price trends, yields, and livability, these are the 2 markets that are currently offering the clearest path to balanced long-term growth. I'll also add that I believe in acquiring a low number of high-quality properties, say 3 to 6 properties, rather than a large number of low-quality properties, say 10 to 15 properties. Because the more properties you hold, the more moving parts you introduce. And unless those assets are fundamentally strong, what you're really doing is multiplying your exposure to high-risk assets and low-quality locations. If that aligns with something you're after, let's chat. You can book in a call using the link below.